All right, so we're on to chapter 6, which is managing cash flow. And we've built up to this first by looking at accounting and accounting statements, and then financial analysis. And now we're going to be managing, looking forward into the next few months for cash flow. So first we're going to look at how do we do budgeting, and that involves income statement, balance sheet, and cash flow statements. Second, we're going to look at how we can achieve better cash management. And so there's some ways to get it. No big secrets here. Get money sooner, pay money later, and go find money. That's basically the answer. And then learning objective 3 is some ratio analysis that would help us look at health and again to simulate what happens if. First, let's take a brief break and say where are we in the stage of our financing and what is going to be available to us. So as we look at the very top of this chart, we can see that if we're at development stage, we don't have very many appealing choices. We could abandon, we could regroup, but there's not a lot there yet to sell or to achieve any valuation. The second stage, if we're at startup, we're starting to get some traction, starting to develop sales and products, but same thing, we could abandon or liquidate, or we could regroup. Next, we get into survival stage where we're starting to get some sales and we're starting to see the possibilities for the company. Here we have a little bit more to do because we could consider restructuring because there is something there. Next, we go to rapid growth, and here's where you're proving that there is definitely something there as customers adopt the new products or services that you're offering. So here we may have the possibility, in addition to getting out, we can harvest. We can go public or we could sell or merge. And then as we go to maturity, we have the same kind of alternatives to us. We could do an exit through selling, or we could do a liquidation or a public offering. So as we progress through the stages, just like we have many choices in financing, we also see different strategic choices that we may have at our disposal. So this is a schematic of creating a budget, and it's labeled A, B, C, D, E because we're going to follow this particular sequence as we go through an example in Excel of how to create a budget. We always start with A, which is a sales forecast. And unfortunately, the most important assumption, sales, is also often the hardest assumption to forecast how quickly your sales will grow. B is we're going to look at how the sales imply a certain level of inventory purchases and how to make those tie. C is we're going to look at staffing. As we grow, we need people. How many people do we need and when and what will they cost? Then D, operating expenses and capital expenditures. These are the other costs that we need to put in place in order for us to succeed. Then E, we pull it all together to create a preliminary cash forecast, and then we're going to refine it with changes in assumptions and also hopefully some financing. So the spreadsheet looks roughly like this, and it's organized in steps like we just discussed, A, B, C, D, E. And this is the final outcome, is to say what kind of cash flow do we expect and what kind of cash infusion do we need by way of equity or debt. So I'm going to hop into Excel right now so we can go through the math that's behind the spreadsheet. All right, here's the Excel sheet, and you can see that it's still labeled A, B, C, D, E. So A is the first step, sales forecasting. And over here, I'm going to expand the A section. And what we're going to do is we're going to start with an accrual basis revenue. In other words, this is how much we sell regardless of when the customers pay us. So there's an accrual basis and a cash basis. You recall that? So this is the accrual basis. How much do we sell? Disregarding for now how fast they pay. So that's right here. As we go from March through August, we expect this type of sale. Notice there's some seasonality going on here. Second step, A2, is how quickly will they pay? And we could have different assumptions here. Here is a relatively simple one. We assume that in the month of sale, we get 60% in cash, and the month following sales, we get the other 40%. As you know, often it takes more than 30 days to collect your money. But here, let's assume that everything is resolved in the month of sale or 1 month after. A3, which is the schedule out based on those assumptions, how fast we get cash. So what you'll see in the spreadsheet is that each row or column or cell is by itself not particularly complicated. So you kind of have to stay with it because there's a lot of numbers and they all have to come together. So I'm going to go through this methodically, and if you do so, you won't fall short. All right, so that's A2, which shows the mix of when we collect money. 60% in the month of sale, 40% in the following month. So let's use that now to create a schedule of cash collections. This is the accrual basis sales for March through August. We know the 60/40, so now we can say out of this 115, how much is cash and how much is credit. So first, we'll take 115 times 60%. Let's lock that with an F4. We take the same amount times 40%, lock that with F4. That's how much you sell on credit. So if we copy this over, we now know for each month how much we receive in cash for the month sales and then how much is deferred until the following month. Now you're seeing a staggering of when we collect cash, which is different from when we account for the revenue. So now we'll go to cash collections. So this is the key that we want, is cash collections, because this is going to carry forward later. So in the month of April, what do we get? Well, we get cash collections from the month of April. Great. We also get the ending receivables from last month. So we get the ending receivable from last month, which is equal to the sales times the credit amount. So we'll receive $36,008 in the following month. Let's do the month of May. First, we got this much in May, cash sales for those we sold in May, plus we get the receivables that were sold in April. They're going to pay in a month. So in May, we collect the credit sales from April. And then June, we get, again, the cash we sold in June, plus the leftover, the receivables that we had in May. And from there, it's the same. So we just copy that over. And we see that in July, it's 69 plus 52. And in August, it's this 52 plus that 46. And then the leftover money here is the receivables that we had in August. So this row becomes quite important. This is the cash collections expected from April through August. All right, so that's sales and the cash flow related to sales. Next, we have inventory. If we know our sales, then we can now estimate how much do we have to buy. This is our assumption that 70% of the sales is what we need to buy for that month's sales. We can look up at the cell. E13 is the sales. So if we sold 115, 70% is cost of goods sold. So that is 80. And here, same thing. It's the accrual basis sales times 70%. So this is an important number because it represents how much do we expect to sell or need to pay in the month of May. However, we also are building up inventory. And here we need a bit of a policy. So here's the policy, is that we need enough inventory at the end of the month to cover 80% of next month's sales, plus another buffer of 46,000. So that's kind of complicated sounding, right? So let's do these, as I said earlier, very methodically so we can go through this. So first, in the month of April again, we need 80% on hand for the prior to the following month. So here, if we look at April, we know May's sales of 128, and we want 80% of that on hand. So we want that much at the end of the month. The buffer inventory is set at a fixed dollar amount, 46,000. So at the end of the month, we know we want 149. This is the amount for each of them. If we go out to say June, we notice that it's 80% of July plus our buffer of 46. So we need 110. Now, we know our cost of goods sold, and now we also know the amount of purchases we need for each month. So again, picking on April, beginning inventory is 110, which is ending inventory March. We have sales in the month of 80. That's going to subtract. That's going to be less from the beginning inventory. And our ending inventory targeted at 149. It's right there. And so we know that our purchase must equal the ending inventory minus what we have before plus what we are going to purchase for our sales for the month. So the purchases for the month of April through August are also known. So this is an important number because these are purchases we need to accomplish this much of cost of goods sold and this much of ending inventory. Right? So that's step B, which is inventory. Step C is staffing. So here's where we say, well, given a certain amount of scale, we're going to have to grow our staff. So the assumption here is we need a certain amount of money for timesheet staff. That's $57.50 per month. And then we have variable commissions, which is 15% of sales. So we have this baseline staff here of $57.50, and we add to it this 15% variable for the month of, again, April. It's 15% times E13. E13 is sales right there. So we're forecasting that our staffing costs will be a combination of a fixed portion, the $57.50, plus the commission portion to get this. So again, this row is important because it is the amount of expenses we expect for staffing. Next is, when do we pay them? And here the assumption is that we're going to pay half of it in this month and half of it in the following month. So again, in the month of April, we're going to pay half of the prior month plus half of the current month. And so in May, again, we have half of the prior month plus half of the current month. Why does this take place? Because they get paid based on timesheets and they submit at the end of the month, and there's a little lag, so we can't pay them immediately. We pay them even a day or so would push us into next month. So this is the cash payment for the timesheet and bonuses that we're going to pay for our people. So that's our staffing cost. That's step C. Step D is other expenses and capital expenditure. Here we have an assumption that we are given a certain amount of money that we need for miscellaneous expenses and rent that was given. And then also we have a truck purchase that we're going to do in April. So now we know our expenditures in the next three or 4 months. Step E is we finally pull all the things together. A couple of other items. First, we have a beginning cash balance we're given at $2,300 with a minimum cash, just to keep us happy that we have liquidity to pay our bills and not get in trouble, is $23,000 at the end of each month. And then we have an interest rate where we have to pay, if we borrow on our line of credit, we have to pay interest on a monthly basis of 18%. So here here's just a general approach that we'll then implement with much more detail. If we have a beginning cash balance and we add to that the cash receipts, then we have amount of money we can spend. We then subtract our disbursements for the month, and then we may be short or have extra money, so there's an adjustment for financing, and that gives us our ending cash balance. That should make sense, right? Beginning plus collections minus disbursements plus or minus some financing cost and drawdowns equals our ending cash. So let's do this now with the data we have. All right, so then we start with the $23,000, which was given. That's right here. We add to it the cash receipts from cash collections from customers. So April through July. So this cell 105 we calculated before. It's right here. So for the month of April, cash collections equals 105. So this particular number, 105, and the strip of data out to 124, we will then use below in our cash collections. So that's where this comes from. I'll just put a note here, from cash receipts. Section. Next, we have a subtotal. So this is the total of 23 plus 105. And we can copy that across. Okay. Next, we have merchandise purchases. This too we have. So this is the next one we're going to look for, and it's also above 119 down to 67 for merchandise. So we'll see it in section B. So 119 to 67 is the amount we are going to purchase. So 119,140 goes down here. 119,140, and this is from the purchase section. And next we have wages. This is the cash flow for wages. So this number we also calculated. So this I'll call green, and we'll look for it, 21,000 down to 24, and we'll see it is right here, 21,000 down to 24, which is section C, the staffing plan. So this is from staffing plan. Section C. All right, next we have miscellaneous expenditures and rent. So here, these two rows, plus this one capital expenditure, we just did above, right here. So this section here represents the other cash flows that we were given in this case. So this is all from section from other expenses, capital expenditures, section T. All right, so now total disbursements. This is sum command, and we just copied across. And now we have, do we have sufficient cash? Now this is the first part where we have to think a little bit. If we had this much cash and this is what we spent, then we have a negative 28. And that's not good enough because we have to have a minimum of 23. So if we're underwater by 28 and we need 53, the total deficiency is actually 51. So what do? We borrow it. So here we have a new borrowing of 51,856. And we'll see something here is if we have the net position right here, and then we add the 51 to it, we'll get 23. So 28 negative plus the 51 ends up being a positive 23, which we force a number, so it better be that number. But on here, I'm just keeping track of what's the loan outstanding, and we just borrowed $51,000. All right. So this is like a snake. It goes up and down like this. So we just went through this particular column of April, and I'll just put a box on it to show the logic we did. So we followed this all the way down. So now we have this number, 23, and we'll just put that in a color purple, let's say. So this number now comes up to here. So this is based on this number. And now we do it all over again. So now we're going to go down this strip of data and see how we're looking. And so we started 23, we collected 156, so we had 179. We spent this amount of money for all kinds of disbursements for inventory, for people, and for other costs. So now we have this position, which is 34,000 positive, which means, oh, we have more money than we need because we only need 23. So what we're going to do is we're going to pay the interest. Interest equals the loan balance right here, 51,000, times the interest rate per year, which we're given up here at 18%, divided by 12 because it's 1 month. So this number here, the 778, represents the amount of interest we pay for 1 month at the 51,000. All the rest of the money that we have to excess cash, if you will, we'll use to pay down the loan. So here we're going to reduce the loan by 10,607, which is that we knew we had an excess of 11,000, and we know we have to pay interest. So the difference, we're just going to pay down the loan, because if you don't need a loan, why have a loan? When we do this, our net position of cash is as follows. We had an excess of cash of 34,000, but we're going to use it to pay down the loan and pay our interest. And when we're done, we have the magic number of 23. So that's 23, and we go up here and we start again. So now we go through this particular month and we say, what do? Well, we had 23, we add 156, we have 179. We spend all this money from above, which means we have an excess of 54,000. Now we only need 23, so once again, we know we're going to be in good shape. We pay our interest, which is equal to the outstanding balance times the interest rate of 18% divided by 12. So of the excess, we're going to use 600 of it to pay the interest, which means the difference between 31 and our interest is how much we could use to once again pay down our debt. So we get to pay down another 30,000, and we end up with 23 again. So now we're to the last month here. So let's highlight that. In the last month, we start with 23, got it. We collected 124, we got that from above. We spend money, got it. So the total expenditure is 102. So here we're at 44,000 left between what we have and what we spend. Now here we have to be a little careful because we only owe $10,000 left on our loan. So first let's pay the interest, which is the beginning balance times 18% divided by 12. Now we have 159, we have 21,000 extra money. So we don't even have a loan that high. So what we can do is pay off the balance of the loan. So notice this number is exactly equal to this number. So we could pay a maximum of what we owe. So we owe $10,597. Let's pay it. And end result is here, which is greater than our minimum 23 because we've made enough money. We borrowed money. We successfully paid it off in the 3 months, paid the interest that was associated with it. Now we have extra money to the tune of $33,000. Right? So this is an example, pretty simplified one of a cash budget, but it's pretty representative of what you would likely see. Our goal is to figure this one out. How much debt do we need to do? And this one out. What is our cash position at the end of every month? And in this case, it's a good news story that we're making money. And although we needed to make a loan, we're able to quickly pay off the loan with all associated accrued interest. We wish it were always that easy.